Good evening. Okay. Yeah, not many people take this subject up. So, during revision, it's just one or two people. Sometimes there are no people at all. Since you have joined, let's do a question today. So now I hope that you're having an idea about the paper structure and all that. Yes. So you know that you're okay. Good. So you have section A, section B. Yes, so section A is a compulsory 50-mark question. And then section B, you have two questions that you need to answer. Yes? Right. So I hope that you have your exam kit and whatnot. You need to do questions on your own. Especially if you are sitting for the exam, this March, you need to do a lot of work, right? Okay, so since you are aware of the exam structure and whatnot, uh, let's straight away get down to business. So now I thought of looking at a question on WAC because that's what we discussed in class. Yes, I thought Hitrimon was also going to join the class, but I guess um, it's just you. That's fine. Okay, so so what I want to look at today is this question. He is not aware of this, I see. But then the message was shared. No? How did you get to know about this class? I saw from Instagram. Okay. Right. Okay. Okay. Now, I usually don't get involved with the marketing of, marketing aspects of BPIM. Uh, but I guess I can, share the recording with Idrima, right? Okay. Right. This is the question that I want to discuss today. It's a 25 marker. It's a question on WAC, right? Now, we have looked at, how to calculate WAC. Yes, WAC is calculated when you have both debt and equity. Yes, okay. So you're looking at a big question, but, the requirements are not that difficult. Requirements, not that difficult. Okay, right. This is a 25 marker. So you know that in professional stage, your professional marks are going to be well distributed among these requirements. Yes. Okay. Uh, so I'm not going to talk about professional marks and whatnot because I am under the impression that you are aware of all those things. Even if you are not, we can look at them later. So let's go through this question, right? This is a solid question on WAC, right? Okay, so what are we looking at? Part A, discuss advantages and disadvantages of demerging sportswear division into a new company, right? So now we still have not looked at this area in class. There is a chapter called corporate reconstruction, right? And restructuring. In that chapter, we talk about how companies are structured, right? For example, we talk about mergers and acquisitions. We talk about management buyout. We talk about mergers, we talk about demergers, joint ventures. All those are there in that chapter. You can go through it. It's there, freely available in your study hub. You can just go through the contents. Okay. Now, here they are asking you to talk about advantages, disadvantages of a demerger, right? Demerger for 4 marks. So it can't be, you know, it can't be that complicated, right? 4 marks, no? 4 marks. Advantages, disadvantages. So how are you going to show your answer? Maybe two advantages, two disadvantages. Yeah, right. Then part B is a calculation. Part B is a calculation. Yeah. So part B, you're looking at 12 marks to do two things, I think. Calculate the change in WACC and uh, valuation of P company using free cash flows. So we did both these areas in class. So this should be doable, right? There's a part C as well. Let's not worry about part C. Can we look at part A and B for now, right? Shall we answer part A? Discuss advantages, disadvantages. Now, let me give you time. Now, see, you have a hell of a lot of information. Yes, you have a lot to read. Yes. So you need to train your eye. You need to train your mind, right? Both, so that you can read the question fast without missing out any key information. Yes, right. Quickly read, right? As you read, try to make notes, right? Now, you're going to have to make notes on Excel. No point making notes on your scratch pad, because actually, making notes on scratchpad is fine, but you can't show the workings, right? You have to show the working, everything in the platform. Yes, right. Let me give you 5 minutes to go through these three paragraphs. Oh, Right. Done. So you're looking at a company. It's an established company. Yes, 10 years ago they have listed. Uh, they have gotten their listing status 10 years ago. They manufacture formal clothing. Yes, 70% is owned by directors or their relatives, and 30% owned by external investors, including institutional investors. Institutional investors are like your mutual funds, pension funds, and such. Okay, right. So here they're talking about sportswear. That's the question, right? Advantages, disadvantages of demerging. Right. 8 years ago, it set up a division to manufacture sportswear. This investment has been successful, and sportswear division now accounts for 40% of total group revenue. Okay, so they have set up this division 8 years ago. Very successful investment. Sportswear is now accounting for 40% of total revenue. Right. So that means they have grown quicker than formal clothing. Uh, Board has given divisional management uh, at the sportswear division more authority over time. Although the board has continued to make major policy and investment decisions. Board has given divisional management more authority. So you have the sportswear division management, right? Who's running the division. Board of this company, board of directors, they have given more power to these divisional managers, but board continued to make major policy and investment decisions. I hope you can remember in PM, we talk about divisional performance, Alamelu, right? In divisional performance, we say that managers should be given freedom to run the company. Yes. So here, managers have been given freedom to run the division. It's not a company, it's a division, but you're not looking at 100% freedom. Yes. So relations between company and management of division, uh, management of sports division were good, but there have been problems over the last couple of years. Sports division's management has been frustrated by refusal to approve their recent investments. So here you can clearly see that the management doesn't have the control. I'm sorry, the management doesn't have complete authority over investment decisions, right? The company's board of directors are refusing investment plans on the grounds are too risky. In order to achieve operational efficiencies, sportswear division management would also like to pursue stricter policies for managing operational staff and suppliers than new timber companies board has so far allowed. These information tell you that the company as a whole and the sportswear division is not falling in line. Yes, the management is, I think, conservative. The board of directors are conservative. They don't want sports division to undertake high risk investments, right? So sportswear division's management, they are very unhappy. Also, sportswear division managers want to achieve high operational efficiency. So they have strict policies than the company's normal policies. Are we clear? Right. Now, can you read this part? Right. Okay. So what are they telling you? A few months ago, management of sportswear division approached company's board with a proposal for a management buyout. Ah, this is what I wanted to explain. Management buyout is basically the management of a company offering to buy a certain division or the company from the shareholders. Alamelu, are we clear? Management buyout. Basically, managers are offering to buy the company, right? The However, the price the sportswear division's management was able to offer was insufficient to persuade the boards to sell the sportswear division. So what are they telling you? The management buyout has not been successful. So management has offered a price, but the board has been like, look here, no, we need more than that. So you offer to buy the company, let's say for 200 million. The board of directors are telling, no, 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 can't sell the company for 200. The board has subsequently decided that sportswear division should be demerged into a new company. This is where the demerger is coming into the picture. The shareholders and proportion of shares held would be the same for this is company P. Shall we call this as company P? The shareholders and proportion of shares held would be the same for P as currently for New Imber. So New Imber, the company is owned by two parties now, 70% by the directors and 30% by the external investors. Now you're looking at this demerger, company P. So they're selling sportswear. They're selling sportswear. No, they're not selling. It's a demerger. So they are going to manage sportswear division separately as a separate company. Shareholders are the same as New England. So shareholders are not changing. Sportswear division senior management team would become the board of P. Ah, okay. That's great. So the management of sportswear is now the board of directors of P. P and sportswear, they're the same thing. Sportswear was a division, but now P is a new company altogether. P would seek an immediate listing on the same stock exchange. Ah, so P is getting listed. Brilliant. Okay. Now, this is financial information. Now I think we can tackle this question. What do you think? What are the advantages, disadvantages of demerging? What are the advantages? What do you think? Be very practical. I know we have not looked at management buyouts in class. Be practical and tell me what are the advantages, disadvantages. Yes, definitely. Yeah, yeah. Now the sportswear division, which is company P, it's a separate entity that is run by, you know, the senior management. Uh, Now the senior management is free to make decisions the way they want. Yes, definitely that's an advantage. What else? Now they're not coming under anyone else. They have the power. They can make decisions the way they want. Now you have to argue, right? You need to explain because the answer is discuss. So, you need to explain in brief. Now, earlier, there was a problem, no? The new member board not letting sportswear to undertake the investment. And now, because it's a separate entity, the company can undertake investments, right? Without any, barriers. There you go. So you can provide that particular explanation there. What else? What else? What else? Think about new IMB. What's an advantage to new IMB? The board of new company may not have enough skills yet, as they were only divisional managers. Okay, now think about it. So managers, these managers, it is clear that they were given authority. See, they were given authority. Division, more authority. There you go. So the divisional managers, right? That was, when it was a division. Now it's not a division. Now it's a company. So the managers before are now board of directors. Actually, Alamelu, it's an advantage, right? You can't say they don't have enough skills. No, that's not very practical, right? The managers, they have a clear understanding of the business. right? They know the business in and out, right? And they were managers before. So now they're senior managers, right? You can't say they don't have the skills. That's not a good answer. Not a good answer. Yes, that's actually an advantage. Now they're hiring the same, they're appointing the same, managers as the senior managers of this company. Now, that's a good thing. That's a good thing because they know they have been in that division for so long. Another advantage is New Imber. Now they don't have sportswear. They only have what? Formal clothing. So they can focus on formal clothing. They don't have to worry about sportswear. They don't have these issues now. They can focus on their core business. That's an advantage. Yes. Are we clear? Okay. Now, what could be the disadvantages? Now I came up. I talked about two advantages. What are the disadvantages? Hmm? Disadvantages of the demerger. Think of the risk of new Imber now. Think of the risk of new Imber. You know that the more the like different segments the company is operating in, the lesser the risk. No. So now New Imber is having only formal clothing. Earlier, they had formal clothing and sportswear both. So company was diversified. Now it's not. Now the company is into just one particular sector, that is formal clothing, right? So the overall risk of New Imber is now higher because they're selling a part of their company. Are we clear? That's a major disadvantage. What else? What else? Shareholders may be now actually in order to do something like this, Alamelu, you need shareholders, you need their support as well, right? You need their support. Come on, this is owned by those people. So you can't say shareholders could be, no, no. Now they have decided. So that means shareholders are also on board with this decision. No, that's not a good answer. Think. Think. What else? Uh, Shareholders approval, I don't think you can talk about it because, you know, they're telling you that the company is going to demerge. Demerge what? Uh, Sportswear. So it's happening, whether they like it or not. So you can't talk about that. Hmm? The disadvantage, yes. Now, after all, whatever said and done, New Imber is going to lose how much? 40% of their group revenue. That's another major disadvantage, right? New Imber is going to lose 40% of group revenue. Are we clear? See, they are right in front of you already. Okay, no need to think very hard. They are like right in front of you. So the company is going to lose revenue. The company is going to lose customers. Are we clear? Are we clear? Those are the problems. Very, 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 very practical, very, very apparent also. Right. Okay. I think that's enough for part A. Very good. Yes, that's a good disadvantage. Cost of the demerger. Come on, you have to go through like a rigorous administration procedure. Yes, definitely that cost will be very, very high. You will have to pay for auditors, you'll have to pay for lawyers, all these other parties will be there. So high cost, definitely. Right. Now we can answer part B. Part B is what? Calculate, first part, the change in weighted average cost of capital of new IMBER if the demerger of the sportswear division takes place. Change in weighted average cost of capital. So you have to find the change in weighted average cost of capital if the demerger happens. So that means you have to find the WACC before the demerger and after the demerger. Alamelu, are you clear? Find the WACC before and after. Are we clear? Right, let's do this. Read the information, right? Uh, so you have to read actually, yeah, this part. Can you find the existing WACC? Can you find the existing WACC? I'll give you time. I'll give you time. Right. Do it. 9.46. Okay. Okay, now can you find the WACC after the demerger? After the demerger, give it a try. Does the KE changes with the demerger? Yeah, no, it should. It should. Cost of your asset beta definitely changes. Sure, I'll explain the calculation. Okay, wait. One second, Alamido. Right. Let's go through this. So what are we looking at? Share capital is, okay, you know what? I'm going to copy this. One second. Let's do this on Excel. Huh? Ah, Ridwan is also here. Okay, good, good. So we are discussing a question. Ridwan, you're late. We started the class at 6. Right. Okay. 1 second. There's another message on the group. Just got to know. Okay. Okay. Cool. Right. So we are looking at a question on VAC. Right. Wait, hold on. There's another person who wants to join the class. Right. Okay. So, Hidriman, we are looking at a question on VAC. So this is there on your revision kit as well. Have a look. Not that difficult, right? So we just finished looking at part A. Uh, part A is part A is where we talk about advantages and disadvantage of demerging the sportswear division in this question. Yeah. Right. So there is another person. Hello. Uh, Good
Hi,
evening.
sir.
So
Good
hi.
evening.
Yeah, we start the class at 6. Not sure whether the link wasn't
Uh,
on the
yes,
group.
I was expecting, the 7 o'clock class, but I missed the notice. Yeah, it's fine. Yeah.
Yeah. Okay. Uh, so we started looking at this question on back. We have looked at the first part. Now we are going to look at part B, the weighted average cost of capital. Um, right. Let's go through this. Okay. So the requirement is to calculate. One second. Right. So the requirement is to calculate uh, the WACC before and after the demerger. Change in the WACC if the demerger takes place. So change in WACC. We have to find delta WACC, right? So change in WACC is basically what? The WACC before the demerger and WACC after the demerger, right? So change in WACC, I'm gonna say change in WACC is equal to WACC before the demerger and minus, or you can say WACC after the demerger minus WACC before the demerger. WACC before the demerger. Right. So let's have a look. So this company is going through a bit of a structural change. For Hidriman and Anton, who joined late, so this company has two divisions, sportswear and formal clothing. So this company is demerging their sportswear division. Sportswear division is now becoming a new entity, right? So they want us to calculate the WACC before and after. Let's see. Market cap of New Imber company share capital 585, right? So that's value of equity, no? Yeah. Market value of equity, right? That's your market cap. How much is that? You're looking at 585 million. 585 million. So 585 million, right? They have 200 million 5.9 loan notes whose market value is 220, right? So they give you market value of debt as well. Market value of debt. Market value of debt is 220 million, right? Interest rate of debt is 5.9%. Okay. Loan notes are redeemable in 5 years at a premium of 5%, right? So redemption premium 5%. 5%. Okay. People, so they have 200 million. So this should be the face value, right? 200 million. So redemption premium at 5%, right? So if you want to calculate, the value of debt or whatever, actually value of debt is given 220 million. So you know that at maturity, so this is redeemable in 5 years. So I'll say T 5 years. Yeah. So redemption premium is going to be 200 plus 200 into 5%. Yes. So that's 110. 200 into 5% is 10, no? 210. There you go. This is the value of loan at the redemption, right? At time T5. Okay. They have equity beta currently estimated at 1 point. Okay. So beta equity 1.4. So you know that equity beta has two things. Yes. Equity beta has two things. You have operational risks and financial risks, right? Equity beta 1.4. Done. Current cost of equity 11.8%, right? So that's KE, right? KE 11%. Done. 11.8%. 11.8%. Okay. 11.8. And its current before tax cost of debt. Cost of debt is cost of debt. So I'll say KD pre-tax. Cost of debt, I'm sorry, before tax. That's 4.5. Done. Asset beta of the formal clothing division is estimated to be 1.21. Okay, they tell me asset beta, right? So that is beta assets. I'll say clothing division. How much is that? Clothing division, you're looking at 1.21. 1.21. The weighting in estimating overall asset beta is 60% for formal clothing and 40% for sportswear division. Hold on. The weighting in estimating New Imber's overall asset beta. Right. So they're telling me asset beta. How is this made up of? 60% formal clothing, right? Overall asset beta is 60% for formal clothing to 40% for the sports division. Now, okay, 40% sports division. All right. I know the overall asset beta, no? Overall asset beta. Do I know that? Asset beta of formal clothing. I know the asset beta of formal clothing. Formal clothing. Beta formal clothing, how much? 1.21. 1.21. Okay, done. Debt beta can be assumed 0. So beta debt is 0. That is the case always. Right. Okay. I think I can find the WACC before the demerger with this information, people. No need to look at the rest. Let's find the WACC before the demerger. WACC before. So that's easy, no? WACC before. So I know the equation, right? It's MVE, right? MVE divided by MVE plus MVD, right? MVD into sorry, into KE plus the whole thing. Copy this. This is MVD and KD. Don't forget 1 minus T. Right. People, I know the value of debt and equity. No? That's 585, 220. Right. So 585 plus 220, that's 805. Okay. Market value of equity, that's 585. Okay. They give me the cost of equity. There you go, 11.8. So 0.118. Right. 0.118. And then, so out of 805, we copy this same. Out of 805, debt accounts for 220. Cost of debt pre-tax 4.5. This into 1 minus T, no, this is pre-tax. 4.5 into 1 minus T. What is the tax rate? Tax rate. Okay, tax rate is there. Tax rate. Where is the tax rate? Our tax rate is 28%. Tax rate is 28%. Right. Let me copy this as well. Okay. Tax rate is 28%. So 1 minus 0.28. Alamedu, is this how you found the back before? Is this how you found? Is this how you calculated the WACC before? Is this 9 point something? Yeah, 9.46. Brilliant. So answer is 9.46, guys. Yeah, 9.46. Done. This is the WACC before. Yeah, 9.46. Okay. Hidriman, that should be the answer. This is the WACC before. Now, what do? I have to calculate the WACC after the demerger, right? Can say WACC after. Right. Now what's happening, guys, after? So they have formal clothing, they have sports division. Now sports division is going out. Sports division is going to go out, yes. Are we clear? So you know that asset beta is what? Is comprising now. Here they're telling you that asset beta is comprised of 60% formal clothing, 40% sports division, right? How do you find asset beta? You know the equation, right? In the AFM paper, you get the, 1 second. One second. I have to get the AFM formula sheet. 1 second. To show you the equation as well. Goodness. AFM. Right. So you know how to calculate asset beta, right? Asset beta, we know it's the ungeared beta. Asset beta derives from beta equity and beta debt, right? There you go. This is my asset beta. This is my asset beta, yeah. There you go. Are we clear? Right. Let's copy this. Do the working, right? Just to show you how to get the asset beta. There you go. Are we clear? Are we clear, people? Right. So, okay, good, good. People, they tell me beta of equity is how much? Beta of this company as a whole is 1.4. Are we clear? Beta of this company as a whole is 1.4, right? I know equity beta has two things, operational risks and financial risks, right? Now, from this equity beta, I need to remove financial risks to get the operational risks, right? Operational risks is what is denoted through beta assets. This is this beta, right? There you go. I hope that you understand. This is this beta. So from this equity beta, right? From this equity beta, I need to remove the financial risk. Does that make sense? Does that make sense, people? Yeah. Does that make sense? Uh, then I'll be able to calculate what? Will I be able to calculate the overall asset beta? Can we do a calculation like that? Hmm? Can we do something like that, people? Is that possible? Or is there another method? Hmm? They tell me formal clothing asset beta is 1.21. Formal clothing asset beta is 1.21. Okay. So I need to find this company's WACC after, right? Okay. Company's WACC after demerger, the company is not going to have no sports division. No sports division, yes. No sports division. Right. So this is going to go out. Does that make sense? Yeah. We know equity beta is 1.21. 1.21. Okay. Anu, they tell me asset beta of formal clothing is 1.21. Okay. Guys, I think we can use this equation, no? We can use this equation. Okay, let me do something like this. Okay, so I know my, one sec. Yeah, I know, now hold on, no sports division. 1.21 is the set beta. Okay, you know what? Okay, I can say beta of formal clothing, beta assets. So that's beta assets, formal clothing. That is 1.21. Yep, 1.21. Okay, 1.21 is equal to, now can we find beta of equity of formal clothing? Can we do that, guys? Because now, okay, let's do this, right? Guys, I know the asset beta, right? Asset beta of formal clothing. After the demerger, you're not going to have the sports division, right? So therefore, you're going to have only no sports division, only formal clothing, only formal clothing, right? Only formal clothing, right? So let's find the beta equity of formal clothing. They tell me beta equity of the entire company is 1.4. Can we calculate beta equity of this of only formal clothing? How do I do that? People, in the question, they tell me in the first part, right? I have to go switch back and forth from the case study. Not let me share my entire screen. Right. Here, guys, you can clearly see in return for 40% of issued share capital of New Imber, the current shareholders will receive 40% of issued share capital of the new company, right? Corresponding to assets and liabilities being transferred. In return for 40% of issued share capital of New Imber, right? In return for 40% of the New Imber company, current shareholders will receive 100% ownership of the new company. Okay. After the demerger, the shares in New Imber company which shareholders have given up will be cancelled. the shares in New Wimber Co, which shareholders have given up. Okay, guys, now, now this company is getting, divided into two, right? New Wimber company has the sports division. Now the sports division is getting removed, right? So after the demerger, New Wimber company's new market cap can be assumed to be 351. So this is the market value of the new company, 351, right? After the demerger, company P will have no long-term debt. The liability, 200 million loan notes remaining with new company. Okay, with New Wimber. So what's happening, guys? After the demerger, the new value of the company is 351. That is the market cap. Okay, that's great. I need that here. Okay. So value of equity is going to be how much? 351, no? Value of equity is going to be 351. Does that make sense? 351. People, you don't have debt. You don't have debt. So what am I trying to calculate here? You're trying to calculate this company's new equity beta, right? Okay, so after you sell that company, after you sell the division, your value of company, value of equity is 351. 351, the debt is still going to be there, 220. 1 minus T, tax is 0.28. Yeah. What I don't know is beta equity. Beta equity. There you go. So this component is 0 because beta debt is 0. Guys, are we clear? So what are we calculating here? Beta equity of the new company. So what is this beta equity? So now you have to simplify this. No? So here you have 351. Here you have 351 plus 220 into 1 minus 0.28, 509, that into beta equity. Yeah. Right. So what's beta equity? Can someone get me beta equity? Can someone get me beta equity? This is the new equity beta of the company after the demerger. So the new company, guys, new company, if you didn't understand this, new company has a value of equity, value of market value of equity of how much? 351. New company is going to have a market value of debt 220. There you go. So why is your equity coming down? Because you're selling part of the company. Does that make sense? You're selling part of the company. 1.756. Okay. That's the new equity beta. 1.756. Guys, you can clearly see that your equity beta is increasing. Yes. Equity beta, when you had both formal clothing and sportswear, was 1.4. Now what's happening? Equity beta is increasing. Obviously, guys, it has to increase. No, why is that? Because now your company has only one division, so risk is increasing. Alamelu, are we clear on this calculation? This is the new equity beta. Hidriman, I hope that you're clear as well. New equity beta of the company after the demerger. After demerger. Right? Please go through the case study, guys. In the case study, they tell you in return for 40% of issued share capital of New Wimber. What is 40%? Okay, so 40% issued share capital of new member, guys. 585 is the value of the company before this demerger, right? 40 in return for 40%. So 40% of 585 is 234 people. 234. Ah. So the remainder is what's going to be the value of the company. Why is that? In return for 40% of issued share capital of new member, current shareholders will receive 100% of the other company. So guys, you are selling your shares and buying new shares of the new company. That is what's happening, right? If you didn't understand this, right, let me do a small working as to how you're getting this value. Before demerger, MVE, what was MVE? 585, right? With demerger, what is happening? With demerger, what is happening? With demerger, 40% of existing shares you need to sell. For 40% of existing shares, 40% of sales of, let me say, sales of 40% of existing shares. So what is that? 585 into 40%, right? So what's the remainder after demerger? MVE. After demerger, MVE is 585. There you go, 351. That's how you get this 351. Now, you don't have to calculate this. They give you this straight away. Alameru, are we clear? Are we clear? Yeah. Hitriman, I hope that you're not too lost. And Anton, hope that you're getting this as well, right?
Yes, yeah.
Right, super, super. Now what? Now I know the equity beta of the new company. Getting it? Okay, brilliant. Now I know the equity beta of the new company. Now we can calculate KE of the new company, right? So beta, now we can say using beta E new, we can calculate new cost of equity. New cost of equity. Oh, I can say cost of equity of new company. People, this new company is still, new member. Can I say KE of demerged company? Demerged company. Otherwise, you'll get confused. You think that I'm calculating beta equity of the new company. No. Right. So now what do? I use, obviously, they talk about what risk-free rate and all that. So we have to use CAPEP. Risk-free rate is 3.4, right? 3.4, 0.034 plus. Beta of equity is 1.756. That into what? Into here, guys, they tell you market risk premium. So market risk premium is ERM minus RF. Yeah, straight away 6%. So this into 0.06. This is your K. This is your K. 0.034 plus 1.756 into 0.06. People, you're looking at cost of equity 14%. You're looking at a cost of equity of 14%. Are we clear? 14%. Yeah. Good. Good. So this market premium, Alamelu, I hope you're clear as to how you get this market risk premium. The risk premium is simply ERM minus RM. Straight away. Everyone, I hope that you're clear on this. Yeah, yeah. Okay. Right. Now you know KE. Yeah. Now you can calculate the WACC. No. Now you can calculate the WACC, right? Guys, now you have to understand, this company's debt is remaining the same. Nothing is happening. Now you can calculate WACC. WACC. Okay, can you get me WACC? Can you get me the WACC of the new? Hurry up. 2 minutes. Get me the WACC. Get me the new WACC. WACC. It is same thing. Only your cost of equity and value of company changes. Cost of equity is 0.14. This is 351. Here 351 plus 220. So I'll simply say 571, 220, 9.85. 9.85. Let's see. Okay, I'll take your answer. I'm too lazy to calculate this. Come on. Can do it, no? 9.85. Are we clear? Now you can calculate the change in WACC, no? Get me the change in WACC, delta WACC. Change in WACC. So WACC has increased, no? WACC has increased 9.85. 9.85 minus 9.46. 9.85 minus 9.46. So your WACC is coming down. Sorry, WACC is increasing marginally, right? It's a 4.1. 4.1? No, 0.04%, no? Yeah. This minus this, no? Marginal, teeny tiny increase, 0.4% increase, right? 0.4% increase is what you're looking at. Are we clear? 0.4. Now, so the requirement, guys, hold on. You can see the requirement is to calculate the change in WACC of new Imber, right? So for new Imber, the cost of cost of capital is higher. People, can you calculate the WACC of the new company? Can you calculate the WACC of the new company? Can you do that? So the new company, guys, it doesn't have debt. It only has equity. How much equity? This much equity. How much? This much equity, no? Yeah. Can we calculate the WACC? Can we calculate the WACC for the new company? New company? New company has only what? New company has only the sports division. They give you, they tell you the the beta, they tell you the set beta? No, no. How do you calculate? It's not required, guys. This is not required. What I'm asking you to calculate is not required. Can you do that? Back of new company, P company, PICO. How do you calculate that? Now P company has only sports division, nah? Only sports. Only sports. Please look at the data. Look at the data, will you? Hurry up. What can we do? Because I think you have to go with this. Then only you can get the asset beta of sports division. Right? You have to go with this logic, I think. So you have to go with asset beta. We found the asset beta of the other company, right? Sorry, we found the beta equity of the other company, 1.756. They tell me, that equity beta is 1.4. Equity beta of the whole company is 1.4. Equity beta of the whole company is 1.4. The beta of the whole company is 1.4. Can we do something like this? Thinking, yeah. Equity beta new imper. How much? 1.4. T beta 1.4. Yeah. 1.4. Okay. Okay. So equity beta is 1.4. I can use this same equation again, right? Let me put it here. Equity beta is 1.4. No? I can find beta of the company. No? There you go. That's how you find it, people. You need beta of assets, right? See, you know, asset beta is getting divided into two. There you go. That's the key, people. Right. Got it. People. So what do I do? Beta A is equal to VE. Now we have to use previous values. Yeah, previous values 585. I'll copy these. No, you don't need that. No? $585. 585. So this is, no, I have to show this separately. No? This into 1 minus t. 1 minus t is 0.28. That into equity beta 1.4. There you go. People. So this is how we get the beta of the company. No? Asset beta. How much is this? Asset beta. Can someone get this value? Guys, what are we doing? Please get me this value, then I'll explain. Hurry up, hurry up. Can someone get this value, please? So what are we getting? We are getting the asset beta of the company, right? Asset beta of the company. So this is when original scenario, right? Okay, hold on. Asset beta, you're looking at 1.1. Okay, 1.1. Now, this is the overall asset beta. No? I'm going to say overall asset beta before the demerger. Before demerger. This is overall asset beta before demerger. Before demerger, there you go. They tell me this. So I will copy this. Right. I'll say from above we know. Right. %40 sports, 60% formal clothes. 60% formal clothes. I know the overall asset beta. How much is that? Overall asset beta is going to be 1.1. Overall asset beta is 1.1. This is how you calculate it. You know formal clothing asset beta. You know that. It's given 1.2 something. There you go, 1.21. So guys, 60%, that is 0.6 into the beta of formal clothing 1.21. So this should be 0.4 into beta of sports. No, I don't know. So let me put it as Z. Therefore, I hope you can understand this now. The total asset beta is made up of two things, people. Formal clothing and sports. So 1.1 is the total beta. 0.4 into Z plus 0.6 into 1.21. There you go. This is your beta of sports division. How much is this? People, did you get this? This is how you find the beta of sports. That is what we are going to use to calculate the WACC of the new company. How much is this? Overall asset beta 1.1. This is made up of two divisions. Get the value 0.935. Done. 0.935. There you go. 0.935. People, this is the beta of assets, of sports. Beta of assets, we know it's the ungeared beta, no? AKA ungeared beta of sports. Now I can use that in the CAPM equation. You can see using the beta above in CAPM. Right. So now I can find cost of equity. Risk-free rate is 0.03 something. 0.034. 0.034 plus beta is 0.935, that into market premium 0.06. Therefore, this is my cost of equity. People, this new company doesn't have any debt, right? So I'm using asset beta. See, this is asset beta of sports in the KE equation, right? In the CAPM equation. So here, what do you get? 0.935, that into 0.06 plus 0.034. People, you're getting 0.09. Now I can calculate VAC. No, can I calculate VAC now? Oh, no, not, no need to calculate VAC. Why is that? Because this company doesn't have debt. No? So therefore I can say, since P co does not have debt, KE is equal to VAC. Are we clear? Oh my goodness. The things that we need to do, man. It's not, this part is not required, guys. Only back before and after is what they want you to calculate. But there you go. You need to think a lot. You need to, the answer is not very straightforward. Are we clear? Alamelu, Anton, I hope that you're fine as well. Hidrima, all okay. You have to understand the working, guys. Yeah, if you don't understand the working, problem. Okay, right. Done. That's just one part of the working, people. One part. Understood, right? Now, can we look at the second part? Valuation of P company using free cash flows. We just did free cash flows in class. People, please read the section from here to here. Right? Please read the question, the section from sports division, blah, 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 to here. Right? Identify the free cash flows, will you? Identify the free cash flows. Getting an answer. Done. Okay, brilliant. Guys, what are we looking at? Sportswear division currently has 36 million operating cash flows. Its managers believe that operating cash flows can increase by the following rates once P company is listed. Sportswear division right now they have 36. Into the next 3 years and from year 4 onwards, you're going to have these growth rates, right? Okay. People, can you get me the cash flows? Can you get me the cash flows? So operating cash flow is 36 now. Currently, can you get me the operating cash flows for year 1, year 2, year 3, year 4, right? And onwards. And see the screen. So let me say, but you know what? I'll do the working with this in a free cash flows. Operational cash flows. No, my bad, guys. Yeah. Here, so current year is 0, 1, 2, 3, 4. Right. Current year it's 36, right? We don't have to worry about current year cash flows, people, right? Because when we do valuations, it's always based on future values. Year 1, you're going to look at a 25% increase, no? So that is 36 into 1.25. Does that make sense? Then in year 2, 36 into 1.25 into 1.2. Yeah. Yes. So I'm sure you understand the logic of this. Here 1.2 into 1.15. From year 4, you're looking at a perpetual growth, right? A perpetual growth. Now, you know, when we do valuations of companies, you have to forecast to the perpetuity. You need to forecast to infinity. Yes. Are we clear? We talked about this on Sunday. Yeah. Alamelu Hidriman, I hope that you can remember. So, you know what? Let's not worry about 4. Can we do the working for these things? So 36 into 1.25, then this into 1.2, and this into 1.15. Right there. Now, so you have operational cash flows. Yes, these are the operational cash flows into the next 3 years. I will do the same thing. You know what? Let's. Okay. So I will show the working, but I'm going to do the working elsewhere. So here the growth rate is 1.02 because from 4 onwards, the growth rate is 2%. Right. People, from operational cash flows, you definitely have to pay taxes, right? Why do you have to pay taxes? Please look at the question. Question is based using free cash flows. Free cash flows. So what's a free cash flow? Free cash flow is whatever the cash flows remaining after your taxes, your investments, all that, right? So taxes. Now we are doing this for company P. So you don't have interest. Are we clear? Usually we minus interest as well, but we are doing this for company P, right? So, right, P company forecast. P company doesn't have debt. Remember that. If we had debt, then we would minus the debt as well. Taxes are 28%, so this into 0.28. Get the value. 0.28. This, there you go. and then get the profit after tax. Profit after tax 45 minus 12. There you go. Profit after tax. Right? Or cash flows after tax. We'll say cash flows. No? Yes. Now what? Now what do we do? Now what do we do? Now let's see whether there are other expenditures that I need to deduct. See, valuation of P company using free cash flows. I need to minus investments as well. Can you remember, Alamelu? So here, there you go. Managers believe that company will require 20 million additional assets in year one. There you go. So you can say investments. 20 million in year one, 22 million in year two, 22 in year three, and 25 million annually from year four onwards. There you go. Right. You know what? Can we get this value as well? 35. Let's get this value as well. This into 1.02. Yeah. Taxes are going to be 0.28. Investments 25. Right, now let's get the free cash flow. Guys, are we clear up to this point? Free cash flow 12.4. And this is there 20.61. Yeah. Is this the cash flow, guys? Yeah. Did I make a mistake? No, right? All the values are correct, no? 25%. This is 25 to 1.2, 25, 20, and 15, and then 2%. Right. Yep. Taxes are 28% of each. Cash flows after tax is this much. Right. People, now what do I do? Obviously, guys, I have to discount this now. Oh, right. There you go, people. When you have to discount your free cash flows, you need the cost of capital now. Thank goodness we found the cost of capital before. We found the cost of capital, right? Guys, now, all right, it makes sense, no? So in order to do the calculation, you have to have the discounting rate of P. So let's say you don't do the calculation that we did. This is like this was, I said that this is not required. No? Okay, I take it back. I think this is required, people. Right? I think you have to show this. So discounting rate is 9%. DCF 9%. Now discount the cash flow. So 1 divided by 1.09. Oops. Here 1 divided by power. You can just plug the values in, guys. Yeah. Power 1.09 to the power 2. This is power 3. Now, wait. So why do we calculate taxes when free cash flow is given? Now, free cash flow is actually not given, right? Free cash flow is what you need to find, enter. So see, look at the question, will you? Calculate the valuation of P company using free cash flows. What's a free cash flow? Free cash flow is the cash flow that is available to the firm after deducting all the operational expenses, all the taxes, all your interest payments, right? all your dividends as well. That is, the cash flow that is going to be free for the company to spend on whatever that they want. It's free. Usually from your cash flows, think about this practically. You have cash flows, right? So you need to minus all your production expenses. Then you need to minus your OPEX. Let's say this is my sales revenue, minus production, minus OPEX, minus what? Taxes as well. These are all expenditure, right? Minus taxes. And then after deducting taxes, you deduct what? You deduct investments as well, investment costs. So whatever the cash flow remaining, balance cash flow is your free cash flow, free to the firm. Are we clear? Now, I think I made a mistake earlier when I made the explanation, when I explained this, guys. Now, you know that you have FCFE and FCFF, no? FCFE and FCFF, right? This is free cash flow. FCF valuations. FCFE is free cash flow to equity, right? So I'll say FCF to equity. Here it's FCF to firm. Are we clear? Yeah. This is free cash flow to equity. This is free cash flow to firm. So here they don't tell me free cash flow to whom, right? They don't tell you that, but you need to understand here, you're simply calculating free cash flow to equity, right? Because there are no debt holders here, right? Are we clear? Hidriman, are we okay? Alamelu, all okay, right? Now let's get the PV, present value. Get the present value. This into this into this. Now, what about this value, people? Guys, do you understand that this is a perpetual cash flow? Right? Every year, what's going to happen? Every year, oh my goodness. No, the math is wrong here, people. Right? Okay, what's going to happen? So from 4 to infinity, no? 4 to infinity, right? So what's my cash flow? Cash flow before the perpetual growth, that's 62.5, 62.1, that's this one. So I'll say 62.1. Now this is going to grow at what? At what rate? 2%. This is my perpetual growth rate, yes? Oops. Perpetual growth rate, yeah? And then you have to pay taxes as well. How are we going to find taxes? The math is not, is it right? After, yeah, it's not wrong. Taxes, you know what? We'll find it. No, what the hell? No, math is correct, people. There's nothing wrong with the math here. 0.02, 63.34, right? Okay. So we'll calculate the taxes. 63.34, that into, oh my goodness. We can do something like this, no, guys, yeah? No. I'm sorry, guys. Yeah, I'm thinking, yeah. Thinking like way too many things. You know what? We'll stick to this. Tax is 25% on this. Sorry, 28, no? This into 0.28, 17.74. So therefore, cash flow after taxes, this minus this. People, it was a different value before, no? Did I make a mistake? Was it a different value before? No. And then you minus the investment 25, 20.61. Yes. People, this is what we had before. Now you have to understand This cash flow is a perpetual cash flow, guys. Yeah. This is a perpetual cash flow. Does that make sense? Okay. You know what? You know what? This is what I'm going to do. This is what I'm going to do. Guys, please, erase the working, right? So we'll do a separate working. Cash flows from year 4 to infinity. Let's do another working, right? Okay. So now I have perpetual growth. I have perpetual growth and I have taxes as well. Investments are going to be 25. Oh, right. Okay. Okay. Guys, I can get the present value of investments. Let me get the present value of investments. So 25 annually, right? That's what they tell me. This is to infinity. So this is a perpetual cash flow. So you need to divide it by the discounting rate. That's how you get the present value of a perpetuity. There you go. This is the present value of investment. Are we clear? 277. Alamelu, are we okay? Uh, are we okay with this value? Vidriman, I'm sorry. Guys, I'm like thinking about way too many things. There you go. Present value of investments. There you go. People, do you understand that this 25 is arising in year 4? So I discounted a delayed cash flow, right? A delayed cash flow. So therefore, you need to rediscount it. Can you remember the shortcut? Rediscounting the answer. So 277.8 is the present value of investment, but you need to discount this again by how many years? The year where the cash flow is arising minus 1. So that is year 4, 4 minus 1. Right. So in other words, you need to discount this at, right? I'm going to write this 1 plus 0.09 to the power 3. People, do you understand that this is a delayed cash flow? Delayed, huh? This is delayed. Delayed cash flow rising in Y5, in Y4, sorry, in Y4. Yeah, right. Good, good. Now you need to rediscount this. So therefore, what's your answer? 277 into, I think we found the discounting factor, no, 0.77. People, your investment, present value of the investment is 213.8. 213.8. Are we clear? 213.8. Okay, that's the PV of investment, right? PV of investment. So I'll say refer to working below. Now I have to get the cash flow after tax as well, no? How do I do that? How do I do that? So guys, now, okay, you know what? Can I get the answer in this way? So this is my cash flow after tax in year 3. This is going to go by 2%. Can I do something like that? 44.71 that into 1.02, right? Was that the answer that we got? I have to find the value here, people. So 862.1 to 1.02 into 0.8. Yes, people. There you go. Oh my goodness. Guys, why do we need to multiply this by another 1.02? No need to do that. No. Shortcut, shortcut. Why do we need to do this? No. I can take this value and straight away multiply that by, I end up with the same answer. This by 1.02. See, I end up with the same damn answer. There you go. So now I can say PV of cash flows after tax. Ah. So how much is it, people? So you get 45.61. 45.61. This is what, if you don't understand this, guys, can I put 44 point? So it's like this. Present value is equal to CF into 1 plus G divided by RE minus G. Right? This is the logic that I'm using. So present value is equal to cash flow. Cash flow is 44, year 3 cash flow, 44.71. 44.71, that into 1.02. The whole thing divided by 0.09 minus 0.02. Ah, there you go. This is the present value. People, are we clear? 44.71, that into 1.02 divided by 0.07. People, you're getting 651.488 something. Hitriman, are you clear? Did you understand what I did? Alamelu, are we clear? Did you understand what I did? Hitriman, yes, good. Anton, are we clear? So I got stuck initially, and then I eventually realized that I have to look at the investment and cash flows separately. Right. So here I'll say present value of cash flows after tax. There you go. This is the value. Now I need to rediscount this again, just like before. Rediscount. So shortcut, remember, you look at the cash, you look at the year where the cash flow is arising, or the growth rate in this case is arising from year 4 minus 1. So in other words, 1.09 to the power 3. Done. How much is this? This into 0.772. People, there you go. The value is 502.95. Oh my goodness. This is your present value of cash flows after tax. In brackets, I'll say from Y4 to Y infinity. Y4 to Y infinity. Here also the same thing, present value of investments from Y4 to Y infinity. Are we clear? People, are we clear? Are we clear? Very good, very good. So now we'll calculate the value of P. Oh, value of P. Value of P company. Okay, so I have the discounted cash flows from Y1 to Y3. Y1 to Y3, there you go. So 11 point, so I'll come up with a small working. Y1, Y1, Y2, Y3, Y4 to infinity. What are the values? 11.38, 11.38, 14.21, 14.21, 17.54, and this is 502. Therefore, value of P equal 546. Done. 546. Are we clear? Yeah. Okay. Done. Very good. Very good. People, if you understood this calculation, so why should we deduct in? Oh my goodness. Oh, damn, I forgot that. Yes, yes. Thank you, Hidriman. Yes, we have to minus the bloody investment. Oh my goodness. Can we say Y4? So from this, you have to minus the bloody investment? No. So can we say 502.95 minus the investment value 230? Yes. 332 is your answer. Are we clear? Guys, are we done? Yes, Hidriman, I made a mistake. You need to minus the investment for sure from this cash flows. No? Yes. So therefore, let me say present value of free cash flow from Y4 to infinity. How much is it? 502.9 minus 3, sorry, investment is 213.84. This is equal to 332.2. Good, good. People, are we clear? Done. Done with the valuation. Okay. Right. Good, good, brilliant. Can you explain Y4 to Y infinity PV of? Yes, sure. Uh, okay. So, Idriman, now you need to understand that your operational cash flows are going to grow at 2% from Y4 onwards. No. So what is the Y4 cash flow without the growth? Y4 cash flow without the growth is 62.1, right? This is going to grow at 1.02. Yeah. So you need to keep paying taxes as well. You need to keep paying taxes as well, no? Right? So let me say year five is going to be how much? So year 5, this is going to be into 1.02 again. This is year 5. So this is going to keep growing at 2%. Does that make sense? And then your taxes are also going to grow at 2%. Right? Your taxes are also going to increase. So why do we need to do these calculations like, operational cash flows and taxes separately when we can simply take the cash flow after tax in year 3 and then multiply that by 1.02? You end up with the same answer anyway. You get it? You end up with the same answer. Right? That's what I did. See, this into 1.02. So I never did any of these calculations. I, ignored it because I end up with the same thing. Now what do I do? Now I have to calculate the present value. So what's going to happen? This cash flow is going to grow at 2%, right? This cash flow is going to grow at 2% to infinity. So I have to use Gordon's growth approximation, Gordon's growth method, right? Mathematically, there you go. This is the equation CF into 1 plus G divided by R minus G. So CF is 44. This is going to grow at 2%. So the difference between discounting rate and growth rate, that is 7%. There you go. This is the present value of your cash flows after tax. Rediscount it because your growth is starting from year 4. So you take it to the power 4 minus 1. So that is 3, 502.95. Does that make sense? From these cash flows, you have to definitely minus the investment as well. They tell me investment is 25 million annually. See, 25 million annually, year 4 onwards. There you go. So this is a perpetual cash flow. How do you find the present value of a perpetuity? Cash flow divided by discounting factor, right? That's what I've done here. So you end up with 277. But still, you have to take this back again to what? You have to take this back by 3 periods. Are we clear? Got it. Brilliant, brilliant. Okay, super. Now, guys, right, okay. So now please look at the question, blah, 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 calculate, and then briefly discuss your results. Briefly discuss your results. So you have to discuss, guys, yeah? You have to discuss the results. I think you need to discuss both these results, people. Change in WACC and the valuation. You need to provide a discussion. So explain what's happening, right? Sportswear division is now being removed. So therefore, overall risk of the company increases. Why is that? Because they are only having one sector now. They are only going to cater into formal clothing, right? So your cost of equity is now slightly higher. Yes, that's why your WACC is higher. Are we clear? WACC is higher. Also, guys, don't forget that you're selling your shares, right? How many shares? You're selling 234 million shares and buying the new company. The current shareholders are buying the new company. Are we clear? And then you talk about the WACC of sports or this P company, right? Right? You don't need to explain the calculation. It's just the result that you need to explain. Here, guys, you're making assumptions. What is that? Your cash flows are going to grow at 2% to infinity, right? And your investment is also going to be 25 per annum to infinity. They are your assumptions. Are we clear? So can discuss, right? Can say something. Are we clear? Guys, now obviously, you're not going to be able to do the calculation. If you can't do the calculation, then you can't do the discussion. That's a normal thing. Are we clear? Are we clear? Alamelu, Anton, and Hidriman. Hope you hope you can do something for this part. Discuss. And then last part, discuss the factors which may determine policies the company should adopt for communication of information to shareholders and other significant stakeholders. So what are the things that they should consider? No, that's what they're asking, right? Um, what are the things that they should consider? Discuss factors which may determine policies P company should adopt for communication. Guys, now a lot of unnecessary wording. Discuss factors which may determine communication of information to shareholders. What are the factors that's going to determine what? Um, determine determine communication to shareholders and other significant stakeholders. Hmm? Yep. People, you can write any valid comment here. Are we clear? Any valid comment. Discuss factors which may determine policies company P should adopt for communication of information. Factors which may determine the policies. Guys, what do you think? Discuss factors which may determine the policies. Discuss the factors which may determine the policies. What do you think? Hmm? What are the factors that they should account for? Hmm? Communication with stakeholders, yes. Who are the stakeholders, people? You can talk about, investors, you can talk about employees, suppliers. Yes. Now, so it's a generic answer that you need to write here, guys. Yeah. Different information needs of each stakeholders. Okay. Okay. What else? Yeah. So now, for example, uh, uh, now discuss factors which may determine policies points company should adopt. Guys, now for example, now all companies, they have to maintain effective communication with their stakeholders. If not, stakeholders are going to get what? Dissatisfied. Think of employees, think of suppliers. Now that this question talks about some operational efficiency somewhere. Can you remember? Uh, strict policies for managing operational staff and suppliers. So I think, the new company should inform, should speak to, employees, should let these suppliers know that they are going to have different policies compared to new Wimper. Are we clear? Now the company is getting demerged now. So, so they have to keep their stakeholders informed of the new policies. Are things like that is what you need to discuss, people. I'm not going to spend a lot of time on this. I'm sure you guys can come up with something relevant. Look at the case study. Do not come up with generic points, even though this is a generic question. Make it related to the case study. Always write something that is related to the case study. Otherwise, no point, people. Are we clear? Are we clear? Alamelu, Anton, and Hidremon. Okay. So I'm not going to come up with answers, guys. I'm here to, show you, I'm just what I do in revision is I show you the way, I show you the method. I don't give you, I'm not, even in my, any other like, revisions, uh, in all the other revisions actually, I want you to change your thinking pattern. I want you to change your like, the pattern or the method at which you approach the answer, right? Your thinking. So to tackle something like this, which is a very generic type of a question, you need to have a proper idea of the case study. Make the answer more related to the case study. Do not write generic answers. Are we clear? Are we clear, people? We spend a lot of time on the valuation, people. That's okay. I hope that you understood. Uh, Idriman, do you have any questions? Yeah, within 2.5 hours, we can do only one question here, guys. Yeah, this is a late evening class, so I'm not going to drag the class till 9:30. Class is maximum 2 to 2.5 hours. Yeah. So here, guys, I put some like points for the first question. Advantages, disadvantages of a demerger. That's very simple. We talked about it. I will share my working on the group. So the very first question that we have looked at is on WAC. I will be looking at another question which will cover like lot of areas. Yeah, in the next class. Are we okay? Idriman, are we okay? Alamelu, when's our regular class? Idriman, as usual, regular class is on Saturday, Sunday. This is a free for all revision class. This is not a revision class just for you, right? This is a revision class that we do for all the students in the market. They can join this class, if they want. It's like that. We have our normal class on Saturdays and Sundays. Okay, right. With that, guys, let's wrap things up for today. Thank you so much for joining. Hope you learned something from this session. So from next week onwards, make sure to join on time. We have our class on Tuesdays, no? From 6 to 6 onwards. Okay, right. Thank you very much, guys. Thank you, Alamelu. I'll see you on. Thank you. I'll see you on Saturday, guys. Okay.